Consecutive increases of 0.75%, the Federal Reserve raised its short-term borrowing rate another 0.5% Wednesday. It's slowing an aggressive series of rate increases while continuing an effort to cool the economy and dial back inflation. Alexis Christoforous has the story.
Borrowing money just got more expensive after the Federal Reserve hiked its key interest rate for the seventh and final time this year.
The FOMC raised our policy interest rate by a half percentage point.
That's a historically big move, but a smaller increase than the past 4 rate hikes. What does that mean in dollar terms? If you have a fixed 30-year, $300,000 mortgage, you're paying about $500 more each month than at the start of the year, simply because of those higher rates. If you carry a $5,000 balance on your credit card, this year's 7 rate hikes means you'll spend an additional $1,600 in interest payments alone. The Fed trying to slow the economy to reduce prices, and there are signs it's working. The November inflation report showed prices cooling, but the cost of everything from groceries to rent is still too high for the Fed, which is why the central bank signaled more rate hikes to come, but perhaps less aggressive.
The Fed can be more comfortable in slowing down its pace of rate hikes. They're much more likely to do adjustments in the policy rate of 25 basis point increments, and that way they can see if this positive trend in inflation continues.
Economists hoping the strong job market and consumer spending will prevent the economy from slipping into a recession in the new year. Higher interest rates are good news if you have money in the bank, where returns are now above 4% on savings accounts and certificates of deposits, levels we haven't seen in 15 years. In New York, Alexis Christoforous, ABC News.